Well, good morning, everyone. It's exciting to be here this morning. I'm Ed Grier, Dean of the School of Business at Virginia Commonwealth University, and we're so pleased you can join us this morning for our first in our series of business conversations. There's certainly a lot of conversation out there about COVID-19, and we want to give you some information, and we have a wonderful speaker that can talk to you about that from an economic standpoint and beyond. Well, this has been a trying time for all of us, not just here at the School of Business, but certainly across the globe. We say at the School of Business, we are powering the future of business through creativity, and we're going to do that. And certainly, we had to do that over the last few weeks. This is our third week of teaching 100% online. And I'm so proud of the creativity and the innovation from our faculty, staff, and everyone involved to get us here. But equally as important, we appreciate our community, and you are our community, our donors, our business leaders, friends and families, as we say. So it gives me great pleasure to provide this opportunity to talk to someone that I'm very close to. He's a great friend, and that is our distinguished professor, Jeffrey Lacker. And you all know he was the president of the Federal Reserve for many years right here in Richmond. So Jeff is very smart. He has a great sense of humor. But one thing that I like the most about Jeff, he's such a great mentor as a colleague for our professors. And so I just love him for that. But before I turn the presentation over to Jeff, just a little bit of housekeeping. We have about 45 minutes. Many of you have submitted questions already, and so we'll try to get to as many as we can. But there's a chat feature in Zoom, and we're all getting used to the Zoom technologies. So if you have additional questions, please submit those questions, and we'll try to get to those as well. So I'll turn it over to Jeff. And Jeff, I hope you're doing well this morning.
Definitely am.
It is unusual to see you in this setting, Jeff. Your office is just one floor down from mine, and we always pass each other in the hallway. So I'm getting used to this social distancing, but obviously we have to do it right now. So Jeff, I'll turn it over to you, and then we'll give you the spotlight for a bit, and you take as long as you want, and we'll try to answer as many questions as we can.
Thanks, Ed. Happy to do this. I hope everyone is safe and well, and and their families are as well. I know this is a trying time. It's a very strange time. It's sort of a surreal time. Just on a personal note, my wife and I were traveling for most of the month of March. We left on February 25th for a long-planned trip to New Zealand and Australia, and COVID-19 was certainly on the horizon then, but it was, a fact that day-to-day life was pretty normal around here in the United States. We were riveted to the news while we were over there and couldn't tear us away from our iPads when we weren't sightseeing or doing whatever. And it was surreal to watch things unfold from around the globe. We cut our trip short a couple of days and got back. Things were starting to close up. Came back on March 25th. We returned to, we did like a fly-in park at the Reagan National. We parked our car at the Crystal City Marriott and took a shuttle over to the place. And then when we left, the lobby was full of some Legionnaires convention. And then when we got back on Saturday the 25th, 4:30, we call up, the shuttle's canceled. We get in a cab at 4:30. He says he's been there since 10 a.m. We were his only ride that day. We get to the lobby of the hotel and there's one person there, and it's the person behind the desk. We go to our car, and it was like the last open parking place when we got there, and the parking lot was virtually deserted. There were maybe half a dozen other cars. So it was quite a change to come back. The world has changed discreetly since we left, had changed discreetly since we left, and it was really vivid and brought home. My expertise is in economics, a little caveat before we start, not in virology or medicine, but to understand and to get a handle on what's likely coming ahead for the economy. I, like many others, have been sort of forced to be a consumer of medical analysis and prediction. So not really positioned to weigh in on the merits of various epidemiological projections. I dig into the methodology a little bit, but I'll try and stick to the economics of this downturn. And economic downturns is something I've been following for over 40 years. And we're certainly in the midst of one. So this is a contraction we're in the midst of. It is extremely compressed. It's almost instantaneous. A typical economic downturn unfolds over several months, maybe several quarters, as weakness in one sector spills over, their purchases from other sectors dampen down demand elsewhere. They lay off people, and it gradually spreads. So for example, in the 2008-2019 recession, the contraction phase took 18 months. We're getting contraction in essentially 2 months right here. A virtually simultaneous reduction in economic activity across a broad range of sectors. And it's familiar: airlines, hospitality, leisure, restaurants, things deemed inessential. A little choppy, it's a little inconsistent across various jurisdictions, but a simultaneous reduction in economic activity. The result has been a record-breaking pace of contraction. It's also the case that we're going to get a contraction that is very, very deep. We got a clear sign of that in the employment report that was released this past Friday. It's the first sort of concrete economic data that for the month as a whole that reflects the effects of COVID-19. So the timing is critical here for interpreting the report. The report pertains to the week containing the 12th. So that was, like the second week in March, essentially. And it showed that from the point of view of their survey of firms, employment was down 701,000, which is a huge number. That there's a separate survey that's a component of that report that surveys households directly. And those numbers are a little choppier, a little bit more movement, a little more volatile month to month. That survey showed a job loss of 1.7 million people. And that's the survey from which we derive the unemployment rate. That was up to 4.4%, a sizable movement, 3.5 to 4.4 in 1 month. But as I said, it just covered basically the first half of March. April is going to be quite dramatic, and the indications we have of that are the numbers that come out every Thursday on the previous week's filings for unemployment claims. And so the key number there is initial claims. So people newly applying for unemployment insurance. And those were just off the charts. You may have seen the New York Times front page or the Wall Street Journal. So far, over the 2 weeks since mid-March, the last 2 weeks we have reports from, last report I think was the 2nd of April. We have a 10 million, 3.3 the first week, 6.6 the second week. So a flow of 10 million into unemployment. And to put that in perspective, in the 2008 and 2009 recession, it took about 16 months for the flow of initial claims for unemployment insurance to accumulate to the same number. So for it took us 16 months to get to the same number of people claiming unemployment insurance for the first time. So a measure really of the depth of this contraction. Broader measures are going to take time for us to see: retail sales, industrial production in the next couple of weeks. Various industry estimates, auto sales are down substantially. The measure of economic activity for the second quarter won't come out till late July, but forecasters are projecting between 20 and 25% lower economic activity in April, May, and possibly into June. Now, little aside on a subtlety of how some of these economic data are presented, you'll sometimes see, well, the general thing for GDP numbers is to present numbers as a percent growth at an annual rate. So if the second quarter is 20% lower than the first quarter, they express that as if it was compounded over 4 quarters. So that would show up as something like 80%. There's a compounding thing in there. It's not exactly 80%, but so when you're consuming economic data, make sure you know whether it's at an annual rate, it's compounded at an annual rate, or it's just month over month. I think month over month is a sensible way to do it. So it's very clear that this is a very large recession. To put the numbers in perspective, employment fell 6% in the 2008-2009 recession. That was about 2 times as large a contraction as any of the previous recessions in the post-war world, except for the Great Depression, where employment fell like 20-25% basically. So this is a sizable contraction. Now, it's going to be deep, but it looks as if I think prospects are good for it not getting deeper after the depth it reaches in the next month or two. And the reason is that what would drive a deeper contraction is weakness in demand. And I think that there's a lot underway. We can talk about that later if you want, that is going to limit the extent to which there are follow-on effects. So I think the major question about this contraction is how long it's going to last. And for that, I think Dr. Fauci said it right, the virus is in control. It's in the driver's seat on this. It depends on when we can lift the social distancing guidelines that are keeping economic activity depressed. I don't want to get stuck in some partisan sort of tar pit on this, but if the main purpose of social distancing is to flatten the curve in order to stretch out the utilization of hospital resources, then a substantial relaxation is probably not likely before there's relative confidence that we've passed the peak and in utilization and are headed down the other side. This week obviously isn't it. That's sort of the criteria I'm looking for. And you can look at the epidemiological projections and map out accordingly. All right, if that curve played out, when would we be confident that we can lift relaxation? And so there are various forecasts from anywhere from the end of May through the beginning of the fall, and they all seem reasonable to me given given my understanding of epidemiology. So what's the recovery going to look like? There's a lot of discussion of that. Finally, so the last recession, the recovery was, there was discussion, is it going to be a V-shaped recovery or an L-shaped recovery? And it ended up looking like a check mark. I guess on your screens it looks like that. Activity fell and then began growing again at a steady rate, steadily climbing out at basically trend economic growth rates, which is about 2% per year for GDP. It didn't snap back to where it would have been had we not had a recession, a trend through the previous expansion, but growth did return. Now, a case can be made now that a sharper V-shaped recovery is plausible. And the case is basically that most recessions involve some economic activity that we don't want to do after the recession. So the last recession, we built a lot of houses going into the recession. The recession basically was the revelation that we didn't need all the houses we built. And so it was clear we weren't going to build as many houses in the future as we had in the past. And so we needed to shift resources, capital and labor, out of housing construction into something else. Here, that isn't going to be the case. I mean, anything that was economically logical in January will, at some point down the road, when the virus is well enough contained that we can go back to normal, be just as economically logical as they were just a couple of months ago. So in theory, we can just all get back to what we were doing. Now, the caveats to that are that we're going to run down some savings in the meantime, and so we're going to maybe throttle back on consumer spending until we build back our savings back up. But the other caveat has to do with whether there are any changes that are of a permanent nature in the way we go about our business. You can imagine things like, less airline travel, less hotel stays, just less going out of fear of the virus. But that's sort of a behavioral factor that hard to get a handle on, hard to know what that's like. And it could happen and yet not have a large effect on overall growth and employment. So just bottom line, very rapid contraction, exceptionally rapid by historical standards. Never seen anything like it. Deep, but finite, likely to hit a bottom in terms of the level of activity within a month or two. At least that's the sort of modal outlook. Uncertain duration, recovery plausible, relatively brisk recovery is plausible, but a range of possibilities are out there. And that's kind of the picture right now. Every downturn has unique features. This one does too. But 2 centuries of economic growth and downturns suggest that we're going to get back to a place where economic activity returns, is vibrant, and we're moving ahead. So that's kind of it in a nutshell. And there's a lot of little details I left out, and we'll see what you have questions about.
Okay, Jeff, let me go to a couple of the questions that were submitted again. So here's one, and you've touched on this just a bit. There's a stimulus package out there. There's a huge infusion of cash into the economy, $2 trillion to impact the economy. So how will that impact federal spending in the long term? So there's another question related to that, and I'll wrap these up as 2 questions. And this relates to the stimulus as well. The US economy is around 21 trillion. If the GDP drops 30%, let's say we go to 15 trillion, is the $2 trillion stimulus enough? And then one more thing I want to add to that, what's the outlook for inflation after all of that?
Those are really good questions. First of all, I don't think of the bill, and I don't think of the aim of policy now as stimulus in the sense of trying to increase economic activity. We want economic activity to be lower now. That's kind of the whole point. We did this on purpose. So I think of the bill and the relief measures as essentially relief, as providing some support to the sectors, the people that we've asked to take a big hit on behalf of all of us. And without any other measures, they might have to suffer a lot while everyone else is working from home and doing okay. What we'd like is to share kind of the burden of adjustment. I mean, it's like a little closed agricultural village that 20% of the farmers get their crop wiped out, and what you like is everyone eats 20% less. And that's kind of where we're headed, to avoid the loss of income for some people, causing them to have to reduce their spending and their well-being by more than warranted. So that's how I think of it. Now, can we afford it? Deficit was large when we came into this. Federal debt was rising as a percentage of GDP. It was on track to be very large 5-10 years down the road. Whether that's sustainable or not is a good question. The flag you would see is interest rates on U.S. Treasury debt in the marketplace. Those have been exceptionally low, which is a sign that the demand for U.S. Treasury debt is so large that we're not near a danger zone yet in terms of issuing too much debt, running too big a deficit. Could that happen? Yes. Is inflation a worry? Yeah, it's always a worry for me, and maybe it's just sort of a constitutional issue. But I think that there are gaps in our understanding of the monetary policy transmission process, and what we know suggests that it's conceivable down the road that inflation pressures could emerge from this. But I'd put them a couple of years down the road and view them as secondary to getting through this crisis with enough measures to help all of the people that we've asked to make sacrifices for everyone's benefit.
Okay, Jeff, you mentioned monetary policy just a bit, and one of the questions is that what's the misconception about this whole economic situation we're in, this crisis? Is there a misconception between fiscal and monetary policy? Certainly there is. Can you just touch on that a bit? That's one of the questions.
That's a good question. The Fed has entered the market with some credit programs where they essentially print money and lend money to businesses, buy corporate debt, buy other securities, money market funds, commercial paper, and the like. And those are often described as flooding the market with funds or the like. And that's really kind of a misnomer. In some sense, the Fed could have bought treasuries instead. They're also buying treasuries. So to some extent, you should think of it as government securities backing those investments. That we're really, what the Fed's really doing there is propping up some asset prices in order to prevent credit spreads widening more than they think is justified. So that's one misconception. So what the Fed does is it's kind of limited, I think, in terms of this crisis, because today what we have is a real shock. It's a shock to real economic activity. The financial sector over here is just feeling the effects of it. So it's not a shock to the way the financial system provides services to the rest of the economy. So there isn't really a problem in the financial sector to fix, as I see it. The problem is the real economy and what's going on there. So I think the Fed is something of a sideshow. I think it's facilitating some lending programs that Congress wants, and so it should be viewed as sort of an arm of the Treasury in this crisis.
Okay, great. And talking about misconceptions too, certainly when you're at the Federal Reserve, the role of the Federal Reserve here in the U.S., it's a domestic issue, right? They're taking care of the problems in the U.S., whether it's inflation, unemployment, and the like. Can you speak about the U.S.'s role across the globe? And there are other central banks, of course. And typically, maybe you can tell me, have they worked together in the past? Will the strength, whatever you want to say about the U.S., can it help the globe get out of this big problem we're having? Can you speak about the relationship with the other central banks?
Yeah, so the cooperation between central banks ramped up substantially in 2008, and the Fed has tapped those relationships to ramp up cooperation again. And the chief form that takes is that around the globe, central banks and governments and other official institutions like to keep their liquid assets in the United States vested in dollars. In addition, you've got a lot of all foreign banks that are active globally are active in the United States as well. And so when some institutions have trouble accessing funding and their central bank wants to help them, the US central bank, the Fed, can help that foreign central bank by lending that central bank dollars that they can use to help their institutions acquire dollars. So there's an established network of lending arrangements between central banks in Europe and Japan and the like. Recently, last week, the Fed announced a broad extension of that to emerging markets. And this is important because I don't know if you've been following this, but the virus has not yet hit places like Africa and Latin America, and it's likely to hit with a lot of force, and they're much less prepared than the developed world is for that. And the adjustments there could be just ferociously costly. And so those economies are going to be put through the ringer down the road, starting a few months down the road. They're really going to feel it. And so the U.S., this is a step they didn't take in 2008, has extended these reciprocal lending, central bank to central bank lending arrangements to emerging markets. Good move, I think.
Good. We're getting a number of questions that are closer to home, and this is from one of our good friends, Brad. I would love to hear your thoughts on how the commercial real estate will be impacted by this COVID-19 in the short term, and how could that change the use of office space and more businesses getting to use through working remotely?
That's a good question. If you think I talked about the possibility of sort of permanent shifts in behavior, and the movement from brick and mortar retail towards online ordering is certainly getting a big turbocharge in this episode. Whether it sort of snaps back to the trend it was on or it's been given a sort of a permanent boost is an open question. As far as commercial real estate office buildings and working from home, it's clear we do a lot from home. It's sort of a pain in the neck, I think people are finding to some extent. It's workable, but the other thing is I just don't think firms are productive if all their people are dispersed and zooming in. I think face-to-face, there's a role for face-to-face. My son works at a big tech company in New York, and they were sent to work at home pretty early on in March. And their bosses said basically, hey, we're only going to be 80% productive as we used to be. So let's throttle back expectations and live with it. So that suggests they'll go back to an office when they get the chance. So it could be, kind of back to business as usual. So it's a bookend of a couple of possibilities there.
Okay, this is a broader question, but similar in effect. What's the impact on banking, financial services industry, short and long term?
That's interesting. So the banking industry came into this exceptionally well capitalized, very strong positions thanks to a decade of work. In addition, their systems, their risk management systems, their information processing systems are top notch. And in addition, they're more resilient. They're, if one of them ran into trouble due to some loan losses in some corner of the world, they are confident about being able to wind them up without collateral damage to the rest of the financial system is much higher now than it used to be. So I think the financial system's, much more resilient than it used to be. Having said that, the Fed has intervened in a couple of markets that it never intervened in before. So going into the corporate debt market and buying investment grade corporate debt and being really active in the commercial paper market again, which they did before, those are going to set expectations that have the potential to tilt incentives going forward. And so, whereas I, in the past, would trust corporate debt market to kind of manage itself and generally keep an eye on excesses. I mean, there were losses here and there, everything. There's always something that goes wrong from now and then, but from time to time. But whereas in the past, I'd sort of have confidence it could manage itself, left to its own devices, basically. Now, less certain. And then that goes double for airlines. I think rescuing the airlines this time raises serious problems, just because we did it after 9/11 and treated it as a one-off, and now a second downturn in airline traffic generates a rescue. When all these companies went through bankruptcy in the 80s and 90s and didn't disrupt airline travel. I just don't see the rationale for it, and I question whether we're going to be able to we have a mechanism for containing the incentives airlines now have to leverage up, given the rescues they've got. So I think those are the big challenges I see. Maybe it's because of my regulatory background. I'm focused on that kind of thing, but that's what I see.
Well, another question just came in, Jeff, and you just mentioned these larger banks, and there's been a lot of consolidation in the banking industry, the big players such as JP Morgan, Chase, and certainly Bank of America, et cetera. What about the small, or let's call them community banks? How will they get through this? And many of those are attached to small businesses also. And if it's an elongated process for those businesses to recover, what's the outlook for those smaller banks?
Yeah, that's a good question. So small businesses have been hit really hard. They're likely to have less financial resources to be able to tide over employees that they have to send home, less able to kind of cover their payroll costs, even if their workers aren't producing and aren't getting revenue. So they're a real source of vulnerability. There is this large program, this SBA program designed to funnel federal lending to small businesses. It opened up on Friday. There was a huge scramble of applications. Apparently Bank of America's applications so far the first day amount to over 10% of the total program. So it's not clear, pretty clear they're going to tap out of that and sell out of that. So I'm guessing there'll be further rounds of that down the road. Not all banks, surprisingly enough, not all banks have invested in the expertise to do small business administration lending. It's technical, you got to get the paperwork just right, get into the system. And some banks who don't are going to lose customers. So I think getting to know federal credit programs is going to be the order of the day for community banks. More broadly, the number of community banks has been falling gradually over the last couple of decades since the 1990s. We deregulated restrictions on banks combining. I think that's going to continue. So I think that a well-run bank needs to be looking ahead and thinking down the road about merger partners, whether they want to acquire or be acquired, or what the future holds for them, what their scale should be. Do they have a back office that makes sense and the like. So continuing challenges for the community bank area.
Jeff, this is a broad question also. We've talked about different industry. We talked about a little bit about construction. We talked about real estate. What about healthcare? I know we're all getting smarter about what the impacts and, different diseases. Any thoughts on that? It's such a big part of the economy, of course.
Yeah, well, my heart goes out to people on the front line that are, working horrendous conditions, places like New York. That's the first thing, first thought that comes to mind. So healthcare is something that's really challenged us as a country. I think we sort of went down the wrong path in the 40s with the tax incentives that led to the widespread of employer-based insurance, and we're sort of digging our way out of that, but I'm not sure we're ever going to get away from it. So we're sort of patching that up. Health policy is sort of another tar pit, in American economic policy that I've watched from afar and had some opinions about. But this is going to be the wake-up call, I think, for the country about its healthcare infrastructure. There's been a fair share of demonization and politicization of how people interpret the roles of various actors in the system. And I think the valiant effort and dedication and devotion of people in healthcare systems is going to be evident as we come out of this. There's going to be a lot of stories of heroism and bravery, and we're hearing them already. And hopefully that'll provide a more sympathetic tone to discussions about ways we might want to alter healthcare provision going forward. So that's broad, high-level thoughts, nothing detailed, but it's going to put it front and center and could alter the tenor of the conversations we have about that as a country going forward.
I'm getting a lot of questions in, Jeff, about, I know you don't call it stimulus package. There's a lot of money out there for small business loans. There's money out there for different industry, whether it's called the airlines, whatever. Of those, which ones do you think have the best chance of working?
Well, this small business program is pretty clever. So it's a loan, and they geared it up. The program was sort of rolled out on Friday, and if down the road, if you've used the money and you've retained your workers, you can deduct from your principal payment the payroll expenses, utility, rent, and the like. And so it's in some sense kind of a grant packaged inside a loan that incents small businesses to retain workers on their payroll. And that's kind of what you want here, right? I mean, you kind of want to just say, all right, let's just all take a time out. The problem, of course, is going to be that firms aren't yielding the revenue that they otherwise would. But you'd like to kind of hold everything in place, keep employers and employees connected, and ride this out for a couple of months, and then let things gradually come back to normal. So I think that's a pretty clever approach and pretty reasonable. I mean, it might founder on this issue of small business revenue. I mean, if a restaurant doesn't have anyone coming to buy food there, that's going to be that's going to sort of gum up the math on that. But that's the one I'd point to. The unemployment insurance extension is something we always do, and I think makes perfect sense in this situation. a lot of the state unemployment insurance systems are a little bit antiquated, clunky. And so it was, and maybe this will be a wake up call on that front, because it proved hard for Congress to craft something that was implementable, that was more fine tuned. In other words, bringing everyone up to 100% replacement wasn't feasible for some states. So they went to this clunky sort of add 650 to everybody approach that became controversial at the end, snagged things at the end, and isn't clearly it's the best compromise now to get it out the door fast, but obviously isn't the right way to go. So maybe there'll be some resources channeled towards modernizing those systems going forward.
Okay, just a couple more here, Jeff. This relates to people that have mortgages and people that want to refinance, and there's always a lag when you see the funds rate is reduced, et cetera. When will that impact mortgages, or will people see a real reduction? Certainly the prime rate, we know about that. But what about for mortgages per se? Whatever, maybe it's 4% right now for a 30-year. Do you expect that to see any movement, or we're kind of stuck where we are?
That's a good question. So the 3 to 4% might be the sort of the bottom feasible mortgage rate for a world where U.S. Treasury rates are, 0.5% or more. Right now, they're 6/10 or something like that. So yeah, the mortgage rate didn't come down as rapidly as the interest rate on U.S. Treasury securities, to which it's tied and moves pretty closely. Various sort of technical things behind that. I think that the critical thing in the mortgage market now is forbearance, and I think that the bill did a good job of sort of encouraging banks to take a pause and let people delay payment, and making sure that doesn't have ramifications for their credit histories, reported credit histories. I think some banks are doing a little bit better job than others. I think the idea of delaying all your payments but having to pay them all in August is a little daunting, and something that allows, a program that would allow a borrower to stretch out the repayment of the missed payments over time, or add them on at the end of the mortgage, would be a little bit more sensible in this time. I've been pleased by the broader extent to which landlords and lenders to landlords have all been, maybe not all, but have been coalescing around forbearance to keep things whole. And that goes to the fact that this is really a temporary thing. I mean, everyone kind of recognizes the epidemiology is kind of limited. It's not going to go on for 3 years, probably. And so I think knowing how temporary it is the thing that saves us here. Knowing that it's it's not because one sector ran amok that we're in this situation. It's because of something outside of our control. So I think it's mobilizing kind of the better nature of a lot of economic actors and leading to, which is sensible, sort of this kind of help for each other in this situation.
Well, Jeff, we probably have time for one more question. So here's one that comes from our good friend E.G. Miller. And he's referencing Vernon Smith's piece in the Wall Street Journal yesterday. And there was a lot of optimism in that article from Vernon Smith, who you quite know well, I'm assuming. Mm-hmm. But can you speak about that? How do you feel about the recovery? Are you optimistic? And just speak about that broadly, if you could.
Yeah, I think Vernon made a really good point that, the American economy is just, brimming with creativity and innovative capacity. And when we clear our way past this, I think we'll get back to that. You can see it now. My wife was sewing masks yesterday. And so she was asking me for dress shirts that I'd outgrown and was willing to sacrifice because it's got the tight weaves that you need for masks. So I have a pinstriped mask now for my wear. But people sharing the patterns online, and stores putting out little kits and stuff. I mean, you just you know, it's just an impressive aspect of American life, that energy is there and people are chomping at the bit to get back to the ordinary course of events. And I think he's right that it'll come. It'll come.
Well, Jeff, I think your optimism, I share that, and we all are hopeful that this will come quicker than later. And this has been wonderful, you to just keep us going here. You're a great colleague. I can't wait to get back into Sneed Hall and we can,
Yeah.
this Zoom technology is really good, but it's not quite the same.
Gets old after a little while.
It gets all over a while. So I think we're all tired. I think you've been wonderful to spend some time with us this morning. We are recording this session, so we'll send it out to everyone, and please share it with your colleagues around the community. So I just want to thank everyone for joining us this morning, and thank you, Jeff. Look forward to more of these business conversations. So we're pleased to do it. And Jeff, you're a great colleague, and pretty soon I think you'll be back to your Formula One circuit racing. I know there's Monaco there in the background. So
yeah,
thanks,
Ed. Thanks, Ed. Thanks, Ed. Stay safe, everyone.
Okay, thanks, everyone. Yeah, stay safe. Thank you very much.